Welcome all. So, we are in the process of learning about the financial planning, and I will now in this class conclude about the say entire discussion on the financial planning. So, we discussed some important concepts, that what is a financial planning and what we include in it, and we discussed that with the say sales forecasting and the projected financial statements and some other important say tools we can go for the financial planning. We discussed at length the importance of the financial planning, relevance of the financial planning, and how we can take the things forward and how we can improve the things, the overall things as far as the financial performance of the firm is concerned. So, now before I close the discussion on the financial planning, I will also discuss one more small problem, which is with regard to say estimating the or learning about estimating the external financial requirement for the given amount or the projected amount of the sales growth, right. Practically how we can do it. So, we have seen it with the help of this model here, that with the help of this model we can do, or we have applied some values also here, and we have found out that how that external financing requirement, which is 2.08 million, we have calculated here, can be calculated. But for example, if you are given some say hypothetical figures or the hypothetical balance sheet. So, from that balance sheet, how can you think about that from this given information, from this say balance sheet, how much is going to be our external financial requirement? Means if we are at this level and we want to grow our sales from the current level to the next level, then how to calculate that external financing requirement. One more problem I will do it here, and then I will close the discussion on the financial planning. So, here I am taking the figures. For example, there is another company, ABC Limited, right. This is a company called ABC Limited, ABC Limited, and the balance sheet of this company is, for example, we have the share capital, right. This is the share capital, and the share capital, for example, is 50 lakh crore, whatever you call it as. This is the figures are in rupees, right. So, this is all the figures we are taking here is as in the rupees. So, this is the share capital 50 lakhs, then we have the retained earnings. The retained earnings are like 60 lakhs, then we are given the long term borrowings. We are given the long term borrowings, LTBs, long term borrowings are given to us here as 80 lakhs or the 80 millions. Then the short term borrowings. Short term borrowings are already with us, which are given to us as 60 millions, and then we are given the trade creditors, or you call it as sundry creditors. You know sundry creditors, when we buy the raw material on credit from the suppliers. So, we have some liabilities, short term liabilities which appear in the balance sheet. They are called as the trade creditors, and this source of financing, for example, share capital is the internal source of financing, retained earnings are the internal source of financing. Retained earnings means the part of the profit which is reinvested back into the business, that becomes the retained earnings. Long term borrowings means long term borrowing from the financial institutions, or maybe from the with the help of bonds or debentures. Short term borrowings is again from the banks or the financial institutions for the working capital requirement or the short term financial requirement. And then we have the now the trade creditors, largely they are called as spontaneous finance. They are called as spontaneous source of finance, and for example, the trade creditors given to us here are 50 lakhs, and then we have the next one is the provisions. We have the provisions here, and the provisions is again 20. So, this total becomes the 320 lakh rupees or 320 millions. The size of this balance sheet from the liability side, if you want to find out, is 320 millions. So, this is the liability side of the balance sheet. Now, I will take you to the asset side of the balance sheet. Again in the rupees all figures are, and here first we have the fixed assets. We have the fixed assets. How much is the fixed asset? 130 lakhs, or we are given the second is inventory. Inventory is how much? That amount is given to us is 90, and then we are given here is as the receivables, or you call it as accounts receivables. I am writing in the short form. Accounts receivables given to us are 80, right, and then you are given the cash. Cash available with us is 20. So, if you total it up, the size of this side also becomes 320 millions or 320 lakhs, whatever it is. So, now this is the balance sheet available with us, and now the present level of sales is in the current period. The present sales, if you calculate the present level of sales is the 400 lakhs and rupees 400 lakhs, and if you next year you want to take the proposed sales we want to make it to how much? 500 lakhs rupees lakhs, we want to make it as a 500. So, there has to be a net increase of the 100 lakh rupees, we want to increase it by 100 lakh rupees. So, the 100 lakh rupees means we want to grow the sales from the 400 lakhs to the 500 lakhs. So, 100 lakhs we want to increase the sales, worth rupees 100 lakhs we want to increase the sales. So, if you want to increase the sales in the next year from the 400 to 500s, and the another important information given to us is the profit. So, here if you look at this balance sheet now, we are given all this assets, this liabilities and assets, and now our say present sales are 400 lakh rupees and the proposed sales are 500 lakh rupees. So, we want to increase the sales by 100 lakh rupees, and profit margin which is say we want to take is 5%, and dividend payout ratio if you calculate is which is given to us is 0.50. This is the information given to us, right. So, we are given this balance sheet. If this balance sheet practically, because if you tomorrow work in the organizations in the Department of Finance, you will find this kind of the balance sheet where you will have on the one side all the liabilities, on the other side you have all the assets. So, we have the share capital, explained it to you what is it. Retained earnings are the profits, part of the profit reinvested back. Long term borrowings is the borrowing which is for a period of more than 1 year. From any source, financial institution and banks. Short term borrowings is a borrowing up to 1 year's period of time, that is called as a short term borrowings. Normally in India we borrow from the banks. Trade creditors, so it means what happens in finance, we have the 3 sources of finance. One is the long term finance, then there is a short term finance, and then we have the spontaneous finance or the spontaneous sources of the finance. Long term finance, short term finance, and the spontaneous finance. Long term finance, if you talk it as, in this case it is the long term finance, up to this it is a long term finance, share capital, retained earnings, and long term borrowings is a long term finance. This one thing is the short term borrowing is a short term finance, and then other 2 sources are called as spontaneous finance. Spontaneous finance is one where you have not to say enter into a special agreement while borrowing any money or any kind of the other inputs. It is a continuous regular arrangement, and as and when there is a need for any particular input, we place the order and the input comes to us, and when the payment becomes due to be made to that source after the end of the credit period, automatically the payment is sent to that source. And that spontaneous finance largely works in case of your say supplies or the raw material suppliers, because raw material suppliers normally supply the raw material on credit, and in India the standard credit period is 45 to 60 days. So, when the raw material arrangements are done with the suppliers, so once a long term arrangement is done by the companies, so when there is a need for the raw material, order is placed with the supplier, and then raw material comes, and after that credit period which has been entered into while entering into an agreement, at the end of that credit period the payment is sent to the supplier. So, that source of the finance where no special arrangements have to be done, no special agreement has to be entered into, is called as a spontaneous source of finance. So, these 2 are the spontaneous sources of the finance. And when we talk about in our model A by S and L by S, so L is particularly the spontaneous liabilities, the spontaneous finance. There we do not even include the short term finance. So, this is the liability side of the balance sheet, this is the asset side of the balance sheet. In this side of the balance sheet, in the asset, these are the fixed asset or long term assets, and all other assets are the current assets. So, inventory, accounts receivables, cash, this all is these all are the current assets. So, we have both fixed assets plus the current assets, and here we have 3 sources, that is the long term sources, then we have the short term sources plus short term sources, and then we have plus the spontaneous sources of the finance, right. We have 3 sources. So, finally, whatever the funds we are generating, we generated 320 lakh rupees or the million rupees, and we have invested that into the different type of the assets, both fixed and the current assets. So, both the sides are equal, 320 is equal to 320. So, your balance sheet is balanced. Current level of the sales, present level of the sales is the 400 lakhs or the 400 millions, and proposed for the next 1 year or during next 1 year we want to attain or take it to from the 400 to 500 millions. So, we want to increase the sales by 100 million or 100 lakh rupees, and our profit percentage is 5% and dividend payout ratio is 50%. So, if this information is available, so to attain that growth in the sales from the 400 to 500 lakhs or million rupees, how much external financing requirement will be there, right. So, in this case external financing requirement we all know can be EFR, we have to work out here, and we have already known the formula for that. So, it means the formula is, we are applying the formula here again, and if you know the formula, so it means, but with the help of simple formula here, this we can use it, A by S minus L by S, right, and the bracket is closed, and then we take it here as what is the total amount is, we are going to multiply it by the say delta sales, that we are going to multiply here by this model. Simple change in the model is going to be here, that is the delta sales minus M, and then it is multiplied by S1 and into 1 minus D. With the help of this model, because we have already discussed this model means earlier. So, the previous problem which I did, that was for the growth rate, and this is for working out the external financing requirement. So, A by S minus L by S into delta sales means the changed level of the sales. If you talk about the changed level of the sales, minus M is the profit margin as compared to the sales that is given in the period, that is the say S1, and then it is called as the dividend payout ratio is 1 minus D is the dividend payout ratio. So, what means when we talk about here is what is the A by S, we talk about here is that is the total assets, we have to take it, A means the total asset, not only the short term assets. So, total assets are how much? Total assets are, the total assets are going to be, the balance sheet says 320, and what is the sales level we want, the sales level currently is 400 minus what is the spontaneous finance level. If you talk about here is the spontaneous finance level is just only 70, this and this, we have not to take even the short term finance in this. So, spontaneous finance is going to be this much. So, this is how much, 70 divided by sales in the period 1, this is 400. So, if you close this bracket, right, and multiplied by the delta sales. So, how much sales we want to increase from the 400 to 500. So, delta sales means the increase in the sales, that is multiplied by 100, and minus here is the bracket, that is 0.05 is the profit, and what is the sales level now, S1, sales are going to be how much, 500, this is the sales level, and what is the D, that is 0.5, because your dividend payout ratio is how much, 50%. Let us be more clear here. So, dividend payout ratio is going to be how much, 0.5% or 0.5 or the 50%. So, this finally the values we have placed in the model. 320 is the total A by S. A means the total asset divided by the sales amount, which is the present level sales. L is the spontaneous finance only, trade creditors and the provisions, 70 divided by 400. And then is the delta sales, means the change in the sales which we want to increase from the present level to the in the future period on the next year, and multiplied by M is the profit margin, which is just 5%, and that is the 5% of the increased sales, and increased sales S1 means this is S is 400, so S1 is 500 into 0.5. So, it means this is going to be the final, we have put the things here in, and if we solve this, the final result comes out as 50 rupees 50 lakh or 50 millions is going to be the total requirement of the funds, that is EFR is going to be, the total EFR external financing requirement is going to be rupees 50 millions if the balance sheet level is this much, which is already prepared by us, 320 millions or lakhs, and the present level of sales is 400 and the projected level of the sales we want to take to 500, profit is 5%, dividend payout ratio is 50%. So, by applying a simple model here, you can find out what is going to be my external financial requirement. So, for example, now you look at how easy it is. We have already estimated before the beginning of that future period that means our say level of sales is 400, we want to increase it by another 20%, so say 25%. So, we want to make it from 400 to 500, means we want to increase it by 100 million rupees. So, if I have to increase my sales, how much funds I require? Because if the funds are available from the market, then only I will grow in the market, or I will think of expanding my market. If the funds are not there available in the market, then I should be satisfied with, or the company should be satisfied with, that sales worth rupees 400 millions or 400 lakhs are enough. We need not to go beyond, because funds are not available from the desirable sources. So, this is the beauty of the financial planning, that what you are going to do in future and how much is the financial requirement for that we have assessed well in advance. And if you have the required amount of the funds available from the different sources, then you go for implementing your plans. If the funds are not available in the market, then you do not go for implementing the plan. So, it means now with these two small problems, one we discuss is about that how to calculate the growth rate without resorting to any external financing. Second thing we discuss here is that if you want to grow from the present level to the next level of the sales and company's performance, how much is going to be the external financing requirement and how to calculate it, and if you know this in advance, then how to arrange the funds from the different external sources which are accessible to the firm. So, I think with this entire discussion of the financial planning, if we little go back in the beginning and try to find out that where we started from and what are the different techniques of the financial planning. So, we started with that we have to first of all take the economic assumptions, or we must be knowing the economic environment in the country. Now, for example, these days if somebody or these automobile companies or the electronics companies, had they been knowing it in advance that there is going to be a recession in the market, right. So, they must not have misplanned their production capacity or their say plant capacity or their say human resources they have hired. They must have been mentally prepared that market is going to be hit by the recessionary phase. So, we have to be very careful about that we are not going to sell in the market in the time to come as we have been selling in the past. So, either we have to reduce the production or we have to look for the markets somewhere else. If we are not able to sell in India, then that leftover production which is there left with us, which we are not able to sell in the present market or in this country's market, we have to think of exporting it to the other countries, right. So, you have two options available at that time. One is that either you minimize you curtail the production and then adjust according to the sales, or you keep on producing whatever you are producing in the past when there is a normal economic trend in the market, and if there is any surplus production left over, that can be sold in the other country's market. So, economic environment, the assessment of the economic environment is very, very important. So, we have to do the EIC analysis, economy, industry and company analysis, and that is always important for the financial planning. After that, then when you come to the company level, you have to start with the sales forecasting. If you know that in the future period of 1, 2, 3, 4 years, what is going to be our growth rate of the sales, then you start backtracking, and then you think of that for selling this much of the product, how much I have to produce and what is the production cost, what is the input requirements including finance, and then we can arrange for the funds. And even we are not only going for assessing the sales, we are going to create the projected financial statement for the next 1, 2, 3 years, so that we know that how your profit and loss account will look like, how your balance sheet will look like, how your cash flow statement will look like. So, if you have already created the roadmap, walking on that will not be a difficult thing, but we have not created the roadmap, and if we are going to move in a phase which is totally full of dark, we do not know what is going to happen in the future period, then I think the firm is going to face so many ups and downs and so many problems. There must be requirement for external funds, but we have not assessed our requirement, suddenly the requirement has come up. So, now we are not able to find the source from where the funds can be arranged. So, financial planning is something which is very, very beautiful process, and the basic tool of the financial planning we use is the budgeting. The process of budgeting, we prepare the budgets for each unit and sub units in the firm, we sum it up and then we prepare the entire budget for the firm as a whole, we prepare the budgeted profit and loss account, budgeted balance sheet and budgeted cash flow statement, and then from the different, say with the help of different concepts, we can go ahead that how we can say assess the growth rate, how we can work out the growth rate of the firm. So, if you know the growth rate in terms of sales, you know the requirement of the funds also. So, whatever the internal funds are available with us, that we know, but what is external requirement? If we know the growth rate, we can assess our external funds requirement also, right. And at the same rate, because you are growing, so growth will depend upon the availability of the finance, and the financial requirement will be possible to be worked out upon the, say, working out the growth rate. So, growth and external source of financing, they are reciprocal to each other, they are complementary to each other. So, we are able to find out that for a given rate of growth, how much external financing requirement is there, and if we do not want to resort to any external financing, what will be our growth rate. So, everything can be worked out with the help of these models and these formulas, and you can be very comfortable that when we are into the real business, we can find out if we have the sufficient external funds available, at what rate we can grow, if there is no external funds available, at what rate we can grow, and if we do not want to have, even the funds are available, but we do not want to borrow any external funds, maybe by way of debt or equity, then at what rate we want to grow, or we can grow, we can sustain in the market, you can calculate the sustainable growth rate also, right. So, with this, say some discussion, some important discussion, some relevant discussion, I would like to stop the discussion on the financial planning. So, financial planning is a very, very important component of the overall financial management, it is a very, very important tool of the overall financial management. So, after discussing the fundamentals of financial management at length, I could discuss with you the concept of financial planning, different tools and techniques of the financial planning, and I think by now you must be clear about that what is the financial planning, what is the relevance of the financial planning, and what are the important tools and techniques of planning for the funds requirement for a future period of time. With this, I will stop the discussion on the financial planning, and in the next class or in the next say part of the discussion, we will now start talking about the next and a very interesting concept, a new concept, which is called as time value of money. So, what is time value of money, how important it is for all of us, and how important it is for the financial managers and the business organizations, that all and everything about the time value of money I will discuss with you in the next class. Thank you very much.